This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Lynn on, and she had so many amazing charts and great topics to talk about on these macro stuff. And I want to really expand on some of those as we get into this chart deck.
Listeners, you'll find the download link for the Postgame chart book in your Research Roundup email. If you don't have a Research Roundup email, that means you haven't yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, look for the red button that says Looking for the Downloads right above Lynn's picture. Patrick, as we dive into page 2 of this week's Postgame chart book, we've got the S&P 500 chart. What's going on here with these two yellow lines?
Well, really, I just wanted to kind of put some further insights on what you were talking about in the market wrap, right? We have a market that more or less has started to run out of momentum. We haven't made a higher high in the S&P 500 in the month of June. Now, obviously, people point out the NASDAQ. We'll get to that in the next chart. But I just wanted to point out the two overhead resistance levels. What's interesting is that will there be some form of a topping formation that at least brings in a correction off of these highs, or is there one more impulse higher on the S&P that will go for a full double top retest of those February highs? And that's one of the really interesting things that we're going to be watching. But what I wanted to really touch on was page 3. What I wanted to look at is the performance of all the U.S. equities. And so what I have here in yellow is the performance of the FANG index. Then in orange, we have the NASDAQ. When the FANG has been up 45% on the year, the NASDAQ has been up about 18% on the year. But then when you get into the S&P, the Dow Jones, and the Russell, they're either flat or down in the case of Russell, more than 10% still from the starting point of the year. And what I really wanted to get across on here is that what is the composition of the rally and where the performance has been. And obviously, it's been in the FANG stocks. But what's interesting is Harris Cooperman tweeted out this breakdown of the median results of the S&P 500 broken down by which category they are in terms of the company capitalization. And what's amazing is that the smallest companies within the S&P 500 have actually had the worst performance year to date. While every tier you go higher in terms of market capitalization, the better their performance has been. And it's actually showing the fact that really, if you have owned the biggest and largest mega cap companies, you actually are doing well. And if you had a diversification into those mid to lower tier capitalization, that you've been massively lagging. And that touches on that point that Lynn made about the equal weight S&P 500 performance versus the market cap weighted, which is the equal weight has materially underperformed. And I think one of the more really interesting investment topics to watch is when will we see this transition moment where more of the broader market will be rallying, where the breadth really widens and where the performance really starts to catch up on these smaller companies versus it being completely lumped into simply these mega cap ones.
Well, and I think that the FANG stocks, getting all of this attention, although I don't think in the long term it really makes a lot of sense, but it's easy to see how it's happening. No matter how bad the COVID-19 pandemic crisis gets, people are going to sit around and bitch about it on Facebook, and they're going to do that using an Apple device. And when they're done bitching about it on Facebook, they're going to order something on Amazon, and then they're going to sit around and watch Netflix because they can't do anything else until they Google something in order to get the latest status of the virus. So the fact that FANG stocks are being bought here, I think may be a reflection of people not knowing what else to buy. But, those are all stocks that no matter what happens with the virus crisis, still have a viable business plan looking ahead.
So, Eric, let's move on to page 4, where I put up the weekly chart of Tesla. And what an amazing chart, the way Tesla has gone parabolic. And, we've had, over the many years of doing MacroVoices together, had the opportunity to go through a whole array of these different securities that have gone into these parabolic phases, whether it was cryptocurrencies or any of the other things that were running really hot into January before the turn. But boy, has this really become this huge story, and the way this is just ripping to the upside. What's your take on all of this, and how far do you think this is still going to go?
Well, Patrick, my take's not that interesting, so let me share our good friend Jim Bianco's take, which he was kind enough to email to me after we discussed Tesla in last week's show. Jim enlightened me by explaining what this is really about is speculation that Tesla is about to be included in the S&P 500 stock index. Now, in order to qualify for inclusion, I think the rule is you have to have 4 cumulative profitable quarters, but it's not like a recession print check where it's just got to be, 4 positive numbers in a row. It's cumulative profits. So it's a question of whether or not there's enough profit to, offset the prior loss and so forth. Anyway, the Q2 earnings have to be reported, and it may qualify Tesla to be added to the S&P. And there's a lot of speculation, according to Jim, in the marketplace that if Tesla qualifies for inclusion, that it likely will be included in the S&P 500. Now, the precedent case, which is probably most relevant, would be when Yahoo was added to the S&P 500. There was something like a 63% rally in Yahoo stock between when that was first announced and when it actually became effective. Now, of course, Tesla has already rallied more than 63%, off of what was the previous high, 900 or so. It's already rallied considerably more than that, but it may not be over, because if there is an inclusion of Tesla in the S&P, it means the index funds have to buy it. It's not a question of discretion or anybody thinking it's a good idea or anybody, being comfortable with the fact that a business that's never had a viable business plan ought to be in the S&P 500. Once that decision is made, if it's made, all the index funds have to buy it. If there's a trade to be found here, Patrick, let's consider that precedent case with Yahoo when it was added. Big rally from the announcement that it was going to be added until the effective date, but then the stock was down about 10% in the several sessions after that effective date. So maybe on the effective date of Tesla joining the S&P 500, if that truly happens, that event of all of those funds being forced to buy it, pushing the price even higher, maybe that's your short entry opportunity there. Certainly, this is a company that has never had a viable business plan. The notion that it's worth, thousands of dollars a share, it's not worth $100 a share as far as I'm concerned. But there's plenty of reason to think that the mechanics of index inclusion could push it even higher.
Well, I'm with you on that we may very well see a sell-on news event, but that will certainly be something to keep an eye on. Anyway, I wanted to move on to page 5, where I put up that daily chart of the dollar index showing that 96 support line you were talking about in the market wrap. But what I find fascinating when I look at so many of these currency charts, whether you look at different pairs like the CAD or the Aussie or the Euro, or you look at this dollar index, from a technical perspective, looks like a very distinct downtrend in the dollar index. And everything is well advertised that the path of least resistance is for it to go lower. This has, in my mind, become incredibly consensus. And I find that it's really interesting that you can see that reflected in the commitment of trader reports. And while obviously when we're talking about COT reports when it comes to currency, the cash markets often are much larger than the speculative markets, so it doesn't have the same weight as if we were looking at COT reports on commodities. But it is interesting to see that speculators are decisively positioned short the dollar. And I asked the question, if the dollar does not follow through to this blatantly obvious breakdown pattern, is there a short squeeze on the other side? And it's definitely something that I'm going to be watching for in the next couple of weeks as we get deeper into the summer.
I agree with you, Patrick. The short dollar trade has become very popular, and if it turns out to be wrong, the short squeeze will be significant and probably create a considerable upside. Let's move on to my own favorite topic of crude oil, as we see here on page 6. Crude oil futures have stopped their epic rally off of those lows back in April, but they've pretty much leveled off. And this is just the August contract chart. If you look at the continuous contract chart, that leveling off is even more pronounced. So the question is, are they topping out and about to move lower because we really do have a lot of bad news in the system around COVID-19? Or is this just a little pause, a consolidation before a move even higher ensues? I don't really know the answer to that question. I've been surprised. I was expecting the answer to be that prices would roll back over and, maybe retrace half of that rally up and we get back down to somewhere between $25 and $30 and then resume the rally from there. So far, we haven't seen that weakness that I was expecting. Let's move on to slide number 7. Our good friend Anas Al-Haji sent me this 5-point update on his interpretation of the significance of the OPEC Plus JMMC meeting and their decision to basically stick to their original plan of tapering back their production cuts starting next month. As Anas says here, he doesn't really think that this is going to be a major impact on the market the way some people are thinking it is. Some people were saying, OPEC's going to produce more energy. That's going to cause the market to crash. Anas doesn't think so. I'll leave it to our listeners to read through Anas's notes for more detail.
Right. And so I just wanted to add one thing onto that chart of crude oil. And what I find really interesting is that while it clearly still looks like the pattern of higher highs and higher lows is going, which is typical characteristics of something in trend, there is substantial divergences in momentum. And there's a substantial loss of that momentum into this rise. And what's going to be particularly interesting is that if the dollar was to surprise everyone with some sort of a reactive bounce off the lows, maybe it puts in motion some sort of risk-off impulse that could potentially trigger some sort of a mean reverting correction in crude. And so it'll be really interesting in the coming weeks whether that really grabs hold. But anyway, moving on to page 8, where we have that chart of gold. And this is exactly the point that you were making. And I wanted to, since we're not going to be on the air for the next 2 weeks, I sort of wanted to go through the thought process of how this plays out. Because, when I think of every guest that we have on MacroVoices, and particularly what's going on in the Twitter universe, it is pretty consensus that gold is the trade to own moving forward. And I totally agree with it. But it feels like it's almost too consensus. And when something is so blatantly consensus is happening, you would have thought that the momentum should have been picking up on a breakout. I mean, if everyone knows that owning gold is the way to go, when we broke out, we should have seen momentum actually accelerate as everyone is chasing the trade, as the buses left the station and they're chasing. The interesting part is that there's no momentum being built here. And that, to me, is a red flag. And while I remain much bigger picture bullish gold, my spidey senses are telling me that something is off here and that maybe we are going to first take a pause here before resuming in the bigger picture.
Well, we're definitely on the same page, Patrick, and our longtime listeners know I was saying for months and months, I really believe in gold long term, but we came up so much so fast. We're overdue for a technical correction. And it doesn't change my long-term bullish view, but we are overdue for a technical correction. And we got that consolidation between 1680 and 1780, 1770 in there somewhere that lasted for several months now. And we've seen this move higher, as you say. The closing above 1800, it should have brought more upside momentum, and it hasn't. Patrick, I've said this before, and I've been wrong about it, but, my hope here is that we're about to begin a very significant technical correction to the downside. And the reason that we're overdue for it is there's a lot of people that have come into this market, the weak hands, as they're called, who, have nothing but profit to show and are not ready to suffer any losses, who will panic if the price price starts to go down, and the selling begets more selling, and there's a lot of weak hands to be shaken out of this market. Maybe we've finally gotten to the point where it's just too much up too fast, and it's time for that overdue technical correction to happen. As you say, it's become too consensus. And the thing is, I'm absolutely convinced that too consensus view is going to be right in the long term. Governments are going to continue debasing fiat currency. Gold is going to do incredibly well over the next 10 years. The question is, over the next 6 months, is there going to be a big correction to the downside? I hope so. I want to buy more.
All right. So, and finally, I just want to leave it with that page 9 where we have that 10-year Treasury yield that we continuously talk about. And I'm going to just keep reiterating the same point that this continues to be my canary in the coal mine. The fact that there's a lot of people out there talking about inflation and all of these different impulses that are coming in the market, but I'm waiting for the bond market to actually start to price this in. And right now, what to me this is showing is that maybe there's still a disinflationary impulse that still can happen, even though I do believe that we are entering a period of secular inflation in the coming decade. It doesn't necessarily have to start, in the summer of 2020. And if we have a breakdown, let's say down toward 50 basis points on the 10-year, to me, that's going to be a red flag that maybe we're going to enter some risk-off impulse here on the broader market. So this is something that I continue to watch and will watch over the next couple of weeks.
And, of course, while MacroVoices is going to be airing pre-recorded shows for the next couple of weeks for our summer break, Big Picture Trading is going to still be at it 4 days a week with the webinar series. So listeners, be sure to sign up for your free trial of Big Picture Trading. All the details are there on page number 10.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.